Hello, it's your financial guru, Craz.ymaestro. Today, we're diving deep into index funds versus individual stocks, and more importantly, what decision makes the most sense if you're a 9 to 5 worker under 30. Let's start simple. Index funds are investments that track a group of companies instead of just one. For example, an S&P 500 index fund invests in 500 of the largest companies in the market. That means with one investment, you're already diversified. If one company performs poorly, others can balance it out. On the other hand, individual stocks mean putting your money into one specific company, like investing in a single business and hoping it grows. If that company succeeds, your returns can be high, but if it struggles or fails, your money is at risk. Now, here's where the real difference comes in: time, risk, and effort. Index funds are perfect for people who don't have time to constantly study the market. As a 9 to 5 worker, your main focus is your job, career growth, and personal life. Index funds allow you to invest consistently without needing to monitor every market move. They are considered lower risk because of diversification and have historically delivered steady long-term returns. Individual stocks, however, require more attention. You need to research companies, understand financial reports, follow market news, and control your emotions when prices go up or down. Many beginners lose money here, not because the market is bad, but because they lack strategy and discipline. So what should you do if you're under 30 and working a 9 to 5? First, understand this: your biggest advantage is time. The earlier you start investing, the more you benefit from compound growth. That's why consistency matters more than trying to hit big wins. For most people in this category, index funds should be your foundation. They are simple, reliable, and don't require deep expertise. By investing a portion of your paycheck regularly, weekly or monthly, you build wealth steadily over time. Think of index funds as your financial engine. They grow quietly in the background while you focus on your career. Now, does that mean you should ignore individual stocks completely? Not necessarily. You can allocate a smaller portion of your money, say 10% to 30%, to individual stocks if you're interested in learning and taking on more risk. This gives you the opportunity to potentially earn higher returns while limiting your downside. This balanced approach helps you stay protected with diversification. Learn how the market works. Take calculated risks without risking everything. Another key factor is emotional control. Many people panic when the market drops and sell at a loss. Others get greedy when prices rise and make poor decisions. Index funds help reduce this emotional pressure because you're not focused on one company's performance. Also, remember to reinvest your earnings, whether it's dividends or profits. This accelerates your growth through compounding. As a 9 to 5 worker, your goal shouldn't be to trade daily or chase quick profits. Your goal should be to build long-term wealth that eventually gives you freedom from financial stress, and maybe even from relying completely on your job. Lastly, stay consistent and patient. Wealth is not built overnight. It's built through repeated actions over time, investing regularly, avoiding unnecessary risks, and staying focused on your goals. In summary, use index funds as your foundation. Explore individual stocks carefully with a smaller portion. Invest consistently from your income. Think long-term, not short-term. You don't need to be a financial expert to win. You just need the right strategy and discipline. Start where you are, stay consistent, and let time do the heavy lifting. Stay smart, stay patient, stay investing,